Good afternoon and welcome to this webinar with Belvoir Group PLC, hosted by Yellowstone Advisory. We're delighted to have with us today CEO Dorian Gonsalves and CFO Louise George.
Alex, thank you. Hopefully you can hear me. Thank you for the very kind introduction. It's interesting to see that we've got a mix of, pretty strong mix of existing shareholders with 25% non-shareholders. And just on that particular point, Alex, I'd like to say that we're always happy to engage directly with shareholders. So if we get to the end of the presentation and someone's got a specific question that we haven't answered, they can always fire that question through either to you or to investor relations, and we'll always respond to their query very promptly. So good evening, good afternoon, everyone. My name's Dorian, as Alex said, and I must have been wishing the day away at that point. I'm also here with my very trusted CFO, Louise. Louise is going to stay quiet through the presentation, unless she can't hold herself back, and then I think Louise will pipe up during the Q&A, which we will do together. We will run through a sort of fixed presentation, which I believe you have got a copy of, and within the slide deck. So we're going to run through about six or seven slides. That's all. At the back of the slide deck, there are lots of annexes and appendices that you may wish to read through separately. The appendices contain a look at our three markets: the rental market, the sales market, and the mortgage market in much more detail. And there are lots of numbers in there if anybody's interested in balance sheet, cash flow, etc. And the slide deck is available. If you haven't got a copy already, it's from Alex. So just a few bits and pieces before we launch the slide deck. So FinCap, our broker, has issued a new research note and market forecast. The report includes a new target share price of 334. We currently, as of a few minutes ago, we're at 240, and we have previously achieved all of FinCap's previous target price forecasts. If you do want a copy of the note, for FinCap's note, it is available free of charge from FinCap, or it's available from Research Tree, or Louise, is it okay if anybody drops a note to Investor Relations? We can also send a link to the note as well. Our current market cap is 86 million. Our share price has doubled in the last 12 months, and I think that's mainly due to a couple of reasons. First and foremost, we're very proud to say that we achieved our pre-COVID market expectations, which actually, considering all the challenges that we had to face last year, we thought was a brilliant achievement. So we achieved our pre-COVID expectations last year. And then the second part of that is that the market at the moment is fairly hot in terms of estate agency transactions. There's also lots of activity on the rental side of our business. And there have been several distortions in our market. The main one being the stamp duty tax break, which has just sort of reached the end of the first part of the end, and it tapers off until the end of September. And I'll sort of talk about that a little bit more as we move through the presentation. We are profitable. Our profit before tax is around 7 million on a turnover of 21 million. We pay a dividend, and we always have done. And then last point before we go into the presentation, we did issue a trading update at the end of May to say that we are materially ahead of expectations based on the trading for the first 4 months of the year. And I think it's fair to say, Louise, that now we've got visibility of further months, that trend is absolutely continuing, and we do intend to issue another trading update in the next couple of weeks. But you're sort of hearing it here first. Okay, so should we move on to the brilliant? Thanks, Louise. So just a brief introduction. So Dorian on the left, Louise on the right. I've got 22 years experience in the property sector. I'm 47 years old. I almost haven't done anything else apart from property. I've been with Belvoir for 16 full years. This is now my 17th year. I do have shareholding in the business, and I'm also very well incentivized for future growth by means of an LTIP sort of share option scheme, as is Louise. But we both have what we feel is, a reasonably good shareholding in the business. Louise, 19 years, very experienced with AIM-listed businesses. Louise maintains a brilliant relationship with our current investors. I think it's fair to say that our investors trust Louise's forecasting. If anything, Louise does tend to err on the side of caution, which I think is particularly helpful, and it was certainly helpful last year as we tried to navigate, a very foggy sort of outlook in terms of forecasting and our numbers. So on to the next one. Okay, so what are we? Well, at the heart of our business, we are a franchise company. So across all of our, or nearly all of our property offices across the UK, we have a franchisee at the heart of each of these businesses. And the reason I stress that early on is that franchising is a business concept in its own right. There are some fantastic franchise concepts around. There are some good ones and some not so good ones, but it's traditional business format franchising is the style of business model. Franchisees tend to be with us for a very long time, and our very first ever franchisee was a Belvoir franchisee. He started with us 24 years ago in the wilds of Scotland, not far from Inverness, and he's getting older, but he's still with us. He's still growing his business every year, and I say that was the very first franchise that we opened. So that sort of leads me into the Belvoir brand first and foremost. So what on this slide? Firstly, we've got our property brands: Belvoir, Newton Fallowell, Northwood, Lavelle, more recently Humphreys, which is an acquisition that we completed on this year. And Nottingham Building Society isn't a brand that we own, but we've entered into a strategic partnership to do a number of things on behalf of the Nottingham. Firstly, when the final deal completes, and if you want to read more about the deal with NBS, if you jump onto belvoirgroup.com, have a look at our RNSs, and we made an announcement a few weeks ago to explain this sort of deepening relationship with NBS, and I'll do my best to explain that during the presentation. So we're doing a couple of things for NBS. Firstly, we're about to start writing all of their mortgages for them. We've taken on their entire mortgage division. And then secondly, the Nottingham have pulled out of estate agency and lettings business, and we're now offering it on their behalf by means of having a franchisee or a staff member sitting within NBS offices offering a property service to NBS clients. And so we've got a slide on that a little later on. The first and Mortgage Advice Bureau, again, that's not a brand that we own. Some of you may invest separately in Mortgage Advice Bureau. It's an AIM-listed business. It's doing extremely well. I think their market cap's about 750 million. Mortgage Advice Bureau is an umbrella mortgage advice platform whereby self-employed mortgage advisors write business and process that business through Mortgage Advice Bureau. They have about 1,500 mortgage advisors in total, all of them self-employed, or nearly all of them self-employed. Of that 1,500 advisor base, 240 of MAB's advisors are ours. So they're either employed by us within our business, or they're self-employed underneath our business, and then we choose to contract with Mortgage Advice Bureau, who process our mortgages for us. So it's an interesting relationship in terms of how we operate with MAB, but the important point is that we represent about 15% of MAB's entire mortgage advisor base. That's quite a new part of our business and quite an exciting concept going forward. So the traditional property brands. So firstly, Belvoir, 163 offices. When I say offices, most of them are operating from either primary or secondary location retail units, fully staffed. None of these are home-run businesses. They're all office-based. The average turnover of a franchisee within the Belvoir brand is about £300,000 per year. And the way a franchise concept works is that a franchisee pays the franchisor, us, a percentage of their revenue, and in exchange we provide website, web security, email platform, business support, training, the entire business concept, which franchisees work within, access to services and products such as financial services, conveyancing, if they're an estate agent, and compliance, all sorts of business support mechanisms that are really intended to help the franchisee grow as quickly as possible, not fail in business, and then continue their growth into decade 1, decade 2, decade 3 in some cases. So we support our franchisees with almost every part of their business. We provide the tools, but we don't dig the hole for them, if that makes sense. And I'm happy to answer any sort of specific questions on franchising at the end. The way our franchise model works is that franchisees are tied in for a period of time. A typical Belvoir franchise agreement is a 5 + 5 + 5 year agreement, so it's 15 years in total. The goodwill of the franchise business is owned by the franchisor, but vested in the franchisee while they have a franchise agreement in place. So my point being, a franchisee can't decide that they're going to close their doors and reopen as John Lewis Lettings tomorrow. They're not permitted to do that, and ultimately the goodwill of their business, if they ever did that, reverts back to us as the franchisor, the goodwill being the clients. So 163 offices. I'll move across to Northwood at the same time as Belvoir because these two businesses are quite similar. So the revenue split within Belvoir, it's 90% residential lettings. So the revenue from franchisees is 90% derived from residential lettings. That's traditional management of properties on behalf of a landlord. And it's around 10% of estate agency. That's exactly the same in Northwood. So we acquired the Northwood brand in 2016. That brought on another 91 offices. Northwood, very similar to Belvoir, 90% residential lettings, which is recurring. This stood us in really good stead during the COVID lockdown last year, the first lockdown. Interestingly, during the first lockdown last year, Belvoir and Northwood franchisees retained 90% of their revenue with their doors closed, which is incredible. Tenants continued to pay their rents. Arrears didn't build up, which was one of the things that we're all mindful of that could have happened during the COVID lockdown period, but arrears didn't particularly increase. They certainly didn't rise to anywhere higher than 4%. But as I say, most of the revenue within Belvoir and Northwood is recurring revenue from lettings. Newton Fowler Well is the other way around. So that's 75% estate agency and 25% residential lettings. I appreciate many of you may not have heard of Newton Fowler Well, but in the East Midlands it's a very, very strong estate agency brand. It's joint #1 in terms of transaction numbers in the areas where it operates. A very strong agent selling thousands of properties each year, and it's fair to say, Louise, that that business is performing extraordinarily well at the moment in terms of new business. Lavelle is a business that we acquired at the beginning of 2020, and I must say that the timing probably couldn't have been worse, and that's the way I felt at the time. The lockdown happened. I thought, crikey, we've just taken on 16 primarily estate agency offices, and we're about to close our doors. But actually, the second half of last year, the market turned completely for us, and we were very grateful to have had a much bigger footprint in terms of our estate agency offices. So we acquired Lavelle at the start of 2020. When we acquired that business, it was part corporate and it was part franchised. We have now successfully franchised out all of the remaining Lavelle corporately owned offices to generally to people who are working in the business. So branch managers have essentially bought the businesses that they've been running, which is just a great, it's a great story. We've helped with funding. So we've turned staff members into franchisees. Humphreys is a deal that we announced a few months ago. So we acquired this in 2021. Humphreys is the other way around again. So it's 90% lettings or 87% lettings and around 13% other income. Humphreys, different to Belvoir and Northwood, Humphreys is primarily a student letting business. So it's managing about 6,500 tenancies across 20 offices, 17 of which are franchised, 3 of which are corporate, and it is our intention to franchise out, similar to Lavelle, to franchise out the corporates at some point in time. And NBS I've touched on, and I'll come back to that later on. And then finally, Mortgage Advice Bureau. So from a standing start, so 5 years ago, we had no involvement in financial services. We acquired a small business back in 2016 called Brook. That was trading as Mortgage Advice Bureau. We bought in expertise, people, and a base model business that we felt could be replicated across the whole of our national footprint, and we're doing exactly that. So we're up to 240 advisors. Interesting sort of stat for you is that 90% of the mortgages that and bear in mind we'll write maybe 15,000 mortgages this year, so 90% of the mortgages that we're writing are not coming from clients that are being referred from these brands, not yet. So we still have lots of work to do. We're getting business from all sorts of areas, including MAB Direct, but we have a lot of work to do still with integrating our franchisees with the financial services proposition. So we've still got a significant amount of upside still to come. Should we move on to the next one, Louise? Okay, so Lavelle, which I've touched on, there's a brief summary of the deal there, and that picture is an office in Lincoln, which is about 20 minutes away from where I'm sitting. The net consideration after we franchised out the 5 corporate offices, he brought the consideration down to 1.2 million. So this is a great buy. EBITDA forecast of 0.3 million. It's accretive from day one, so it's roughly a 4 times multiple of EBITDA. Humphreys at the other end of the slide will end up in a very similar position once we have franchised out the 3 corporates. As it stands at the minute, when we did the deal a few months ago, revenue of 2.8 million, operating profit of a year in the year prior to March 2020. Very good, stable business, and one that we can expand out on, being a student business rather than a residential business. NBS in the middle. Nottingham Building Society. If you've got very good eyesight, you can see that the Nottingham is in blue and Belvoir is in red. That's the concession element. So if a client of the Nottingham, and they've got hundreds of thousands of clients, they've also got tens of thousands of clients saving in lifetime ISAs with a view to buying a property at some point in the next 3 to 4 years. Those clients will be channeled through our estate agency chain and also our financial services business. So although it looks like a very small acquisition, the potential upside with this relationship is really exciting. It's unique. No other franchise networks have done anything like this before, and we're really excited about that proposition. It's also helping us to enlarge our footprint. And the next one. Great. So a few key highlights. So financial highlights, I mentioned earlier that revenue was around sort of 21.7 million. That was 13% up. MSF, which is our management service fee. If you understand the mechanics of franchising and you understand that franchisees pay the franchisor a percentage of their revenue, MSF is really our recurring revenue. So franchisees always pay, they always continue to grow their businesses because they own their respective business. And our MSF growth, if you look back in our growth over the last 20 years, every single year, MSF continues to grow. So it's good, strong, steady growth. And it was up 3% last year, even through a tough year. Profit before tax up 20%, as you can see, and an EPS up 14% to 15.1. EPS over the last 4 years is up 160%, Louise, I think, over the last 4 years when we sort of look back. And then operationally, I've mentioned Lavelle, I've mentioned NBS. House sales last year We're at 8,003, which was an 8% increase, and we're expecting that number to be significantly higher, as you can imagine, with the stamp duty holiday. Mortgages last year, 29% up, which is a great result. And in the first quarter of this year, we had written 4,000 mortgages in the first quarter alone. So project that forward, we should finish the year on 16,000 to 17,000 mortgages, or possibly more than that. Okay, so generally just a few points on why invest. So I've explained the 6 brands that we've got. I appreciate it's been a whistle stop tour through the brands. There are a lot of aspects to our business now, and hopefully that just gives you a flavour of the brands behind the scenes. I made the point at the beginning that our franchisees are really the beating heart of our business. They're entrepreneurial. They want to improve their lifestyles every single year. And our business is completely different to a managed estate agency or lettings business, in that, and I have over the years managed corporate estate agency managers. We would have had a much tougher job last year if all of our 400 offices had been run by corporate managers. When they were run, let me give you an example of why a franchisee is sort of better than a corporate manager. When the first lockdown, when it was announced that the first lockdown was going to end, it took some of the corporate estate agency chains up to 2 months to reopen their branch networks. It was quite a slow process. Branch managers were slow to return back to their offices, slow to input systems, etc., and safety systems. I can honestly say that we couldn't hold our franchisees back. So when the announcement was made at, let's say, 8 or 9 o'clock on an evening, and we were told that we could reopen within 24 hours, the very next day our franchisees were getting their offices prepared. The day after that, they were back in business again, looking to reclaim any sort of income they had lost during the lockdown period. The difference is chalk and cheese. We've had, over the last 24 years, and I've been around for longer than 16 years actually, or 16 and a half years. Of these 24, we've had 24 years of unbroken profit growth, which I think is a great achievement, and we're expecting that to continue this year. Across my own management team, we've got 12 years average length of service, which stood us in very good stead last year, as I say, as we navigated the storm. And then more importantly, we've come out sort of operating a very, very active market. High degree of recurring revenue, which I appreciate has always been important to our existing shareholders. So 60% of our gross profit is from recurring lettings revenue. My history is more lettings than it is estate agency. And we really like the lettings part of the business. We're very good at it. We manage over 70,000 residential properties across the UK. The private rented sector goes through periods of growth and it goes through periods of minor contraction. But if you forget all of the sort of short-term trends, the private rented sector is so significant now in the UK. 5 million households privately renting. There are around 13 million people renting in the private rented sector, and it'll be interesting to see what happens over the next 12 months. I think if property prices remain, particularly strong, then similar to what happened in 2007 and 8, I think more people will end up renting, because as they struggle with affordability, that will sort of push people into the private rented sector. And during the Q&A, if we've got time, I'll talk about sort of trends in property prices and rents and whatever else. Diversification, we've proved with financial services that's going exceptionally well for us. As I say, from a standing start to 240 mortgage advisors over the last 5 years, we think is incredible. We're proving that we can take a new income stream, and you can apply this thinking to a number of different products and services. We've already got the distribution network. We're proving that we can take a product or a service and start to drive sales through our franchise network, and deliver very effective results. On the first slide, I explained the brands that we have. A number of those brands have come via acquisition. On top of our corporate acquisitions, of which we've done 8 since 2015, we also help our franchisees to acquire their competitors. And a few months ago, we reached the milestone of helping over 100 franchisees to acquire businesses over the last 5 years. So in addition to the acquisitions I've mentioned, we've helped franchisees to acquire 100 other businesses that they've bolted into their respective business, which then delivers us additional revenue in terms of MSF, if that makes sense. So on to the next one, Louise. Brilliant. So just a quick summary on the story so far in 2021. We are seeing substantial revenue growth across all three of our markets. So that's residential sales, that's the financial services side, and it's also on the letting side of our business. Management service fees are already up over 20% year on year. Financial services revenue up 24%. Number of advisors up to 240, and these numbers are accurate, Louise, up until the end of April, I believe. Yeah. Written mortgages up over 60% during that period. And then in terms of strategic growth, I explained Humphreys earlier on. We are still very acquisitive. At the moment, our market, as I've said several times, is quite distorted with things that are happening in the market. But what I suspect will happen towards the end of the year is that the market will normalise. And there'll be lots more acquisition opportunities at that point. We've seen fewer acquisition opportunities over the last 3 to 6 months. I think simply because agents are just making hay while the sun shines, and so they're going to make a load of money. Then they're going to say, "Now I want to sell my business." So I suspect there'll be lots of acquisition opportunities around towards the end of the year. As I've proven, we've got a track record in accretive acquisitions, and we do this time and time again. Our strategy is definitely focused on creating shareholder value, and so we've got a lot of very pleased shareholders and a lot of loyal shareholders on board, and trading is exceptionally strong and ahead of management expectations. We announced that a few weeks ago. We intend to say the same again in the next couple of weeks. But I think people are generally looking at the housing market, and I think they can sort of work that out for themselves, that property businesses are performing particularly well at the present time. I think, Alex, I'm on about 28 minutes, so to me, I think that's probably a good time to do some questions, if that's okay.
That's absolutely brilliant, Dorian. Thank you very much for that run through. It's been a great introduction for some people, and I'm sure a number of people coming back will be encouraged to hear how well the business is performing. So we are going to take some questions now. And just as a reminder, if you want to ask a question, please type it into the Q&A box at the bottom of your screen, and we'll try and go through as many questions as we can. I'll start off on one on the Nottingham Building Society. Can you talk through the recent acquisition of the Nottingham Building Society, and how big do you think financial services sales could become?
Louise, do you want to, just in case people are fed up with hearing me talking, do you want to have a go at that one, if you don't mind?
Yeah, sure. Well, the business that we have acquired, and I say have acquired, we don't actually complete on it until the 31st of July. So we exchanged at the beginning of June, but we actually don't complete until the 31st of July. So what we're buying there is actually their existing financial services business that supports the leads and the inquiries from their members that come in the main through their branch. And a number of those advisors, they've got 21 advisors that are moving across to us, and a lot of those are operating out of one of their branches or from their central head office. So that business turns over about 600,000, and in their own forecast should make around operating profit of about 175,000 this year. So that's what we're actually buying as of the 31st of July. And we obviously believe that with our processes and our better efficiencies, we think that we can do better out of that and extract more business and perhaps get a better margin on it. But the interesting part of the deal is actually the fact that the Nottingham have 50,000 lifetime ISA savers. Probably about 80% of those are young people saving towards a mortgage and saving towards a first-time purchase. And they're launching what they call their Beehive Money app at the end of this year, which is actually, obviously, it's an app that will sort of steer their savers along a journey towards saving up for their property, and obviously encouraging them to, leading them, if you like, to inquiring about a mortgage through us. Mortgage Advice Bureau, who we're partnered with, are also working on their digital platform to tie into this Beehive Money app, which will actually take the client, the saver, further along the journey, obviously heading towards and ultimately a mortgage with Mortgage Advice Bureau. So at the moment, that isn't in the numbers that we have, and we can't put a figure against what that will give a benefit out over the next few years. But the Nottingham themselves are expecting to increase their numbers of savers from 50,000 up to 100,000 in probably no more than a couple of years. They've really grown that portfolio of savers very quickly. So we actually are really excited about the potential and the financial services from that. I think if we try to put numbers against it, it would be very hard to know exactly what those numbers might be. And as Dorian said, I'm a little bit cautious. I don't like to count my chickens before they've hatched. So it's a bit of a wait and see on that one.
Okay, brilliant, thank you. And looking at the mix between acquisitions and organic growth, how should we think about that going forward in terms of how that split will pan out?
Do you want me to cover that one as well, Dorian?
Go for it. Thanks, Louise.
I think it's a bit hard to say exactly what the balance will be between the two, but we continue to look at where we can bolt on what we see as earnings accretive acquisitions that fit into our, if you like, our property space. Either if you look at what we've done recently, we've acquired a couple of relatively small but decent franchise networks, so that grows our franchise estate agency, lettings agency footprint. But then we've looked at businesses like the financial services, where we see that our franchisees there can be some overlap with our franchisees offering those additional property services. So a bit of diversification and a bit of building up the platform, and we look for opportunities that can continue to do that. But meanwhile, we look at every opportunity we can see for our franchisees to grow their business. I mean, in a way, financial services has provided a growth path for us as a group, but also a growth path for our franchisees. And as Dorian mentioned earlier, we do a lot of support for our franchisees on the assisted acquisitions, so they too can grow their business. And our franchisees themselves have grown by something like 40% in the last 4 years, in terms of their average office income. So I think on organic and acquisition, it's going to be the same sort of blend as we've seen historically.
Thank you. Got a couple of questions around this subject, which is brands and brand names. Are you diluting the brand by having several different brands in the portfolio? And would brand recognition and retention benefit from marketing only under the Belvoir name?
Yeah, that's a decent question, actually. It's an interesting one. I would say, in terms of brand recognition, that's the right way of looking at it. So actually, in terms of brand recognition, yes, it would be better to have 1,000 offices trading under one brand. I think in terms of business growth and future growth, our methodology at the minute, and maybe I didn't make this clear earlier, that's why I said it's such a good question, is that it is possible for us to have all of the brands that were on slide 1 operating in one town. And in fact, I'm sitting not far from a place called Woodhall Spa on the edge of Lincoln. In Lincoln is the only town that we have where we have all of these brands operating. They're competing against each other. There must be 50 or 60 agents operating in Lincoln, but a number of those agents are within our stable of brands. So we actually think that it gives us more opportunity to expand, because in theory, when we sort of done analysed territories, let's say we can have 500 Belvoir offices under the Belvoir brand. You can actually have 500 Belvoir, 500 Lavelle, 500 Newton Fallowell. There's nothing stopping us from expanding out each one of these brands. But I do accept if we had 1,000 of one brand, it would be easier in terms of marketing, etc. But then on the other hand, there are national estate agency brands who, after spending millions and millions, in fact hundreds of millions of pounds on marketing, haven't captured a significant chunk of the market, and certainly no more than 5, 6, 7% of the market by means of national marketing. I still think that vendors are choosing, and we can prove this by the numbers. So of every 100 properties that are being sold, 90 to 95 vendors are choosing to go with an agent who operates locally, as in has a team of people on the ground who understand their local patch, and only a relatively small number, sub 10%, are choosing to go with an online agent or a nationally branded agent. Because that was one of the other questions, Alex, how are sort of online agents affecting us? So no, we know the strategy for us is working. It doesn't matter that franchisees compete with one another. We keep glass walls between our franchise networks differently to other firms. So, and what I mean by that is a Belvoir franchisee can't buy a Newton Fallowell, and a Newton Fallowell can't buy a Northwood. So we've retained brand integrity multiplied by the number of brands that we've got, and that's working very well for us. It also means you've also got to have a look. You've also got to bear in mind that our whole sector is actually dominated by single players. It's still a massive cottage industry, dare I call it that. There must be 15,000 independent agents operating in the UK that are not part of a corporate network or not part of a franchise network. So these, to me, present acquisition opportunities in the future, both for us at corporate level and for franchisees at ground level. And these independents, over time, will eventually sell up. And businesses like ours with scale, we can deal with compliance, we can deal with training. Regulation is getting much tighter for agents, and it's anticipated that within 3 to 5 years, agents will require qualifications, licenses, all sorts of things. It is going to become much harder for single operators to operate, and it's becoming much easier and more cost effective to operate as a national chain.
Thank you, Dorian. Probably interesting to come on to this question about national chains that sort of link to that. Do you think new types of estate agents like Purple Bricks or Boomin are a threat to the traditional type of estate agency? And do you have a considered, or have you considered a central database to try and match customer requirements and enable house swaps?
Yeah, interesting. So, I mean, first and foremost, Boomin isn't an agent. So Boomin is in the category of property websites like Rightmove, Zoopla, On the Market. They're the three main ones. So actually, Boomin's, I do know Michael Bruce, who runs Boomin. I spoke to him well before he launched Boomin, and we do sort of maintain a dialogue. Boomin is really setting out to compete with the likes of Rightmove and Zoopla, so it's different. Purple Bricks is an online agent similar to Strike, Yopper. There's a whole group, eMove, which has failed fairly recently. There's a little sort of collection of online agents. Not online agents typically charge a fee up front if it's Purple Bricks, and they charge a fee whether the house has sold or not, and that fee might be just a simple straight fee, an admin fee or a sales fee, or it could be a fee for conducting viewings, which is some of the online models charge £600 or £700 for viewings, etc. But my point is the key difference between the online model and, dare I call it, the traditional model, because the word online has been hijacked, Alex, in my opinion. We've been online for God knows how long, and it's just that the online agents are exclusively online. We're online, and we have premises, and we have staff, and we have people on the ground, etc., etc. So the term's been hijacked. The key difference is that we work on a basis of no sale, no fee. So if somebody wants to sell a property through us, we charge not a penny unless the property proceeds and exchanges contracts. And at that point, we typically charge around 1% of the property value. 93% of our business is outside of London. So 1% may sound high in London if the average price is 500,000. The average price for property that we're selling is more like 200,000, 220,000. So it's a couple of £1,000s average fee. Unless we get the price the vendor's happy with and we get it to exchange, we get nothing, not a penny. So that's the key difference. So when you sit in front of someone and you explain that to them, this is why we're doing so well at estate agency. And actually, the onliners are, in some cases, losing market share. I think the public now are getting very wise to the options that are out there. And as I say, 90% of vendors are choosing to go with an agent that works on no sale, no fee.
Okay, thank you.
Property management is different, Alex, by the way. So property management isn't i.e. lettings, which is most of our business actually isn't being threatened at all by onliners. Property management to me is, well, estate agency to me is like a smash and grab type of sales. So you grab the vendor, you do the deal, or you lose the deal. That's it, full stop. It's got to be done very quickly. And if you do happen to do the deal with a vendor, you've got to rush it through to exchange. If it falls through, nobody gets anything. So it's sort of very quick sell. Tends to be very little repeat business because people move on average once every 10 years. Property management completely different. So property management has an element of sales where you let the property, you market it, you find the right tenant for it. But the vast majority of the work happens after the tenancy is being created, where we manage the relationship between landlord and tenant. We visit the property, we conduct periodic visits, we look after maintenance on the ground. And to deliver that, you need boots on the ground. And interestingly, 2 or 3 years ago, I met with most of the online agents. I sort of approached them and had a meeting with them to see whether we could work together, do something with them. And the interesting conclusion at the end of all of that was they wanted what I've got, which is boots on the ground almost everywhere, and they haven't got that. And I wanted what they've got, which was a really nice looking website and lots of money for marketing. So that was my sort of conclusion at the end of that. But we decided that we think our model is rock solid, delivering good results, and we can see a clear pathway for continued growth.
Okay, thank you. Got a question here about, I guess, management remuneration and your sort of shareholding. Can you tell us how many shares management have bought in the company and how many shares they've been awarded under long-term incentive plans?
We haven't got with us, Louise. I don't think we've got that for all of the management team. But do you want to give just a quick flavour of yours, and I'll do with mine?
Certainly. I mean, I joined Belvoir back in 2014, and certainly within the first couple of years, I bought 56,607 shares, through the market. So, and I think, I don't know exactly what my average price was, but I think I would paid around 125 or 116 for some of them. So a mixture. And then obviously, more recently, I've had our previous long-term incentive plan vested, and I exercised my options under that, and the entire gain from that exercise has been rolled into shares. So I now own just over 327,000.
Brilliant. Quick. Yeah, thanks.
I could actually just cover Mark Newton,
sure,
who's one of our other executive directors. Mark holds something over 400,000, might be 430 or 35,000. He actually, when we acquired his business back in 2015, he took part of the consideration for his business when he sold Newton Fallowell to us in shares, and that's the 435,000 shares he still owns today. He has benefited from about 170,000 of share options, but I think, to be fair to him, he did take the gain in cash. I think he felt that he had quite a substantial holding in Belvoir with his original holding, and he's 65 and has got other things he wants to invest his money in to spread his investment at this stage of his life, to be fair.
Brilliant. I think I accused him of being 68 a couple of weeks ago. He wasn't best impressed, actually, but I need to make sure he's 65. So just a quick summary of mine. So I bought, at the point of listing, I bought 650,000 shares. Part of that was funded by a loan. I had to borrow money to buy those shares. I haven't got founder wealth, so I'm 47. I sold some shares in 2013 to repay the loan, which left me with about 450,000 shares. I've then bought a couple of small tranches, 2015 and 17, of 10,000 or 15,000 shares. I've transferred some to a partner just to make the most of ISA tax allowance. That was back in 2017, if memory serves. And then I exercised the first of my options. So I've got a couple of exercises that we've done recently, Alex. So I'll run through those because a few people have asked me about them. So January 2020 was the first time I'd ever exercised any options. So what I did was they were unapproved, so they were tax inefficient. So of the net gain after paying tax at full rates, I left 50% of the net gain in shares, and I took 50% out in cash. It was a relatively small amount of gain anyway. In June 2021, I exercised some EMI options, which dated back to 2014, and for the first time, I actually took a cash gain on that. I didn't leave any in shares, and the main reason for that was I was married in December for the first time. I've got a balance. I've been with the business for so long. I've kind of got a balanced lifestyle with business requirements as well. And so I did exercise EMI options and didn't take any more shares on. But I do intend to increase my holding over the next 12 months, just to be clear. So, you know, that just because I exercised some options and took some cash at that particular point, just after getting married, I do intend to increase my holding over the next 12 months. That'll be by means of the next award. I have an LTIP I'll need to exercise at some point. I intend to do a 50-50 with the next options I exercise, so I can fund lifestyle and I can continue to increase my holding. But just to be clear, most of my net wealth is in Belvoir. I don't have any investments anywhere else. I've got some buy-to-let properties, as you'd probably expect me to have, but you know, my wealth is in this business.
Okay, brilliant. Going back to the business, can you talk about the integration of the Belvoir franchisees with Mortgage Advice Bureau? Is it taking longer than expected? And what is the plan to incentivize franchisees to use more of the MAB services?
Yeah, sure. I think somebody asked, you know, also what's the average commission, you know, that a mortgage broker gets for writing a mortgage. Well, I mean, generally the top line, the sort of commission that's involved, the headline commission, is about £1,500, Louise, give or take, you know, depending on which part of the business. So that's £1,500 in terms of proc fees, commission from the lender, and so I said earlier, I guess what prompted this question was I said that, you know, 90% of the mortgages that we're doing are not coming from the franchise network that's on the screen. The main reason for that is the majority of our advisors are self-employed, so they are tied to us. Some of them sit in branded shops. Believe it or not, we've got 100 premises with mortgage advisors sitting in. You know, some of them are beautifully branded shops with 4 or 5 mortgage advisors sitting in them. Other advisors sit in an office. Some of them sit at home, some of them are mobile, and what's happening more so in the last sort of 12 months is that we're saying to advisors, if you want to sit inside one of our franchises, you can. You know, we've already got the footprint, we've got the client base, you can sit there and you can build a great business. But what I'm coming on to is because these advisors a lot of them are experienced, a lot of them already have their own client base. I actually think it's a real strength that our mortgage business isn't reliant on the franchise business. That's still an opportunity to be explored, and I think why it's taken longer than probably I hoped to get franchisees really sold on the concept. I think COVID is part of that. The very active market in the last 12 months is another part of that, because franchisees are trained. They're trained and experienced agents first and foremost. Anything else is viewed as a peripheral product, an add-on by a franchisee. So they've really been making hay on their core business over the last 12 months, which is fair enough. And as I said earlier, I think that to me is just an opportunity going forward, whereas franchisees get to trust it and get to understand FS more. There isn't anything stopping, and this is now happening in our network. There's nothing stopping a franchisee from building an entire business within a business. As I say, they've got premises. If they want to, they can have 3, 4, 10 mortgage advisors. If they want to, they can acquire an FS business, which hasn't happened yet, but mark my words, it will happen, where a franchisee acquires an FS business and brings it on board. These are just potential avenues for growth going forward. I think what we've done with our franchisees is we've set out a clear methodology by which they can grow their businesses over the next 5 years, and part of that is organic growth, part of that is growth by FS, another part is growth by acquisition, which I think has been another question. And the general mechanics around a franchisee acquisition is, if you put yourselves in the sort of the chair of a franchisee, let's say you've got a good lettings and sales business, mainly lettings, which is typical. So, you know, Belvoir and Northwood represent most of our franchisees, and that's 90% lettings, 10% sales. So let's say you're a typical one of them, 300k turnover, 5 staff, sitting in an office, and you want to grow your business to £1 million of turnover. and we do have a fair number of franchisees now turning over $1 million, so this isn't something new. We help the franchisee to go out and identify potential acquisition targets. I've got a team of people full-time on my payroll who do this. I've got three stroke four people who do this. We identify targets, we approach the acquisition, and we help the franchisee to negotiate a potential purchase of an acquisition in their territory. We've got the operational expertise. In terms of funding, how it works, we're happy to lend money to a franchisee to help facilitate these deals. We're happy to lend up to 30% of the consideration. Typically, we lend more like 10% of the consideration. And in a year that isn't affected by COVID, we'd probably expect to be doing about 7 million of franchisee revenue coming into the business by means of franchisee acquisition. So it's quite exciting for franchisees. Doesn't suit the, dare I say, older franchisees who are thinking of exiting in 3 or 4 years. It's quite a long-term project, but if a franchisee joins us, they buy a resale and they want to grow that, double it, treble it, quadruple it, buying an acquisition is an almost instant way of growing the business. And for the franchisee, it's very profitable. When you put 2 of these small lettings businesses together, you don't need 2 sets of premises, you don't need two sets of staff, you don't need 2 Rightmove or Boomin subscriptions, you need just 1 of them. So it can be very profitable for the franchisee to do this.
Wonderful. Couple more questions here. How much cash is the business sitting on, and what do you intend to do with it?
We're sitting on about 5.3 million of cash, certainly as at the end of June, and that's actually having acquired Humphreys for cash this year. So we've done well with that. We are a very cash generative business. We have achieved, and we're looking to sort of keep a dividend cover of around 2 times. And we obviously have bank debt that we would like to reduce, although it's not very high at the moment. The net debt is down to about 4 million now, so we're getting pretty low. In terms of what we'd like to do with it, we like to use the surplus money that we have to invest in the sorts of businesses that Dorian's described and we've talked about earlier. Businesses that increase our property franchise footprint, businesses that bring in complementary financial property services like financial services. Anything that fits into our patch that we recognise as being a good deal and will be earnings accretive for shareholders. I know 1 or 2 questions, or 1 question you shared earlier was, were we likely to pay a special dividend? I can't honestly see that happening in the near future because of the fact that we do have bank debt to pay down, and we have continued to be quite acquisitive and to find things that will grow, continue with our growth strategy.
Okay, couple of questions here on the market. When will the UK property market return to normal, and what does normal look like? And I guess linked to that is, should people be worried about the stamp duty changes which are coming through?
Yeah, again, good questions, Alex. I think what does a normal property market look like? I think is probably anybody's guess. I think is what does normal look like? It's a tough one, isn't it? And when you sort of look at so what we're talking here is really number of transactions, presumably, so because prices will go up, down, left or right. So in terms of transaction numbers, which is where the key distortion has taken place because of the stamp duty holiday. And I've been through tax holidays before in the property sales market, and what normally tends to happen is that you've got an immense rush for obvious reasons while the holiday is in place. Then you have a sort of steep rise in transactions in the weeks immediately preceding the end of that holiday, and then it drops off a cliff and transaction numbers fall, then they sort of climb back up again. But what I'm coming on to is, if that happens, let's say in April, May, June in a particular year, in my experience, it doesn't necessarily increase the number of transactions, it just squashes them up into a much tighter time period. So when you get to the end of that year and you look backwards, historically, the number of transactions has kind of been a similar level as in previous years. It's just that they all happened in a much tighter period. Now, I appreciate at the moment that will be a little bit different because the stamp duty holiday was was extended. But if I just give you an idea of transaction volumes, then you can make your own decision on what normal looks like. If you wind the clock back to sort of 2005, 2006, so transaction volumes UK wide 1.44 million in 2005 and 6. 1.7 million transactions in 2006 and 7, and then in 2007 and 8. This is financial year, not calendar year. So 1.44 million, 1.7 million, 1.5 million. Then we had the credit crunch. Transaction numbers dropped to around 900,000 sales a year. So the market didn't die during the credit crunch. It's just the transaction numbers on the sales side dropped. On the letting side, the private rented sector grew enormously during that period of sort of 2002 to 2012. It doubled, the PRS doubled in size during that period. So my point being that when the sales market, when and if it does get a little bit rocky, normally the private rented sector performs extremely well. And we listed on the back of, a tough sales market back in sort of 2012 and 13. Then just to bring it sort of closer to recent years, so 2019, 2020 financial year, 1.17 million transactions, let's say 1.2 million transactions, and then the forecast for 2021, bringing it right up to date, but only up until the start of April, is about 1.2 million. It's 1.184. That's the forecast. So the true distortion will come in April, May, June, July of this year. So those figures haven't been publicised yet, but that's where the true distortion will be felt. And I suspect there will be 300,000 to 400,000 more transactions during that period than we would expect in a normal year, whatever normal looks like. So a normal year, I think, probably looks anywhere between 1.2 and 1.5 million transactions. This year, I suspect it'll be 1.5 million. Next year, I suspect it'll be 1.2, 1.3 million, that sort of level.
Okay, great. I think we've got time for one last question, and I will mention two together because it's on the same topic, and it's obviously something that's interested a number of parties, and we've talked a little bit about it, but this is to do with the acquisition on the Nottingham Building Society, or the alliance. So do you see this strategic alliance with the NBS as a model that you can roll out again with other partners? And I guess the related question is, do you think the Nottingham deal will prompt other regional building societies to look for similar partnerships and alliances?
Sort of yes and yes, really. Now I'll add on to that I say it was very difficult for us when we put the announcement together, because we're on one hand we're sort of announcing what looks like a very small acquisition. On the other hand, it is so difficult to quantify, as Louise said, or to put numbers around the benefit that we're going to get from these 50-odd thousand clients, which NBS is sort of forecasting will be more like 100,000 clients in sort of 3 years down the line. It's difficult to put numbers around the upside of those people having mortgages, which they're going to do at some point. They're in lifetime ISAs, and also it's difficult to put numbers around how many of those people might buy houses through us as well. That's the other part that is so difficult to quantify, but we do see a significant upside coming from this. The increase in the footprint was the first step. The second step was to acquire the mortgage writing element of NBS, which, as Louise said, that completes in a few weeks' time. And then the third step is really maximising the value of NBS's clients, as we offer both house sales to them and we write mortgages for them. So yeah, it's a really interesting concept, Alex, and I've learned a lot when sort of going through the process with NBS, and it took quite a long time, I think, for NBS to really buy into us in terms of trusting somebody enough to to hand them the keys to the door. But actually, the more they worked with us, the more they trusted us, and the more they liked our business model and our way of working, our ethos and our staff. And in the end, they sort of backed us 100% by sort of buying into this full alliance with us. So yeah, we're really excited about that. I say it may seem small, but it's exciting, and yes, it's potentially a template for other deals. Yeah.
It's clearly an area that's sort of attracted a lot of interest from shareholders and thinking that there could be huge potential in that going forward. So, you know, thanks for covering.
I think it's an area where there's definitely a big sort of element of latent, you know, or potential growth beyond the sort of normal organic growth that you could expect from the business.
Brilliant. Well, look, that brings us to the end of today's presentation. I'm afraid we've run out of time for further questions, but thank you so much for attending. Thank you, Dorian and Louise, for answering all those questions. Thank you for, as I said, people coming along today. As you leave today's webinar, you'll be asked to fill out a short survey form. If you wouldn't mind completing that, it would be very much appreciated. And just to flag up a couple of forthcoming webinars. Next Monday, we've got British Land. So you want to hear about the state of the commercial property market. British Land will be presenting in a webinar jointly with ShareSoc. And then on going into September, we've got Crossword Cybersecurity presenting. So again, many thanks for attending today, and we look forward to seeing you all soon. Thank you.
Thanks, Alex.